What if I told you that two of the most popular ways to build wealth are basically in a fist fight, and most people have no idea which one is winning? Real estate or index fund? You've heard both. Your parents probably swear by one. Your finance feed on X screams the other. But what does the actual math say? And more importantly, what does it mean for your life? By the end of this video, you will know exactly how these two compare, what the data actually shows, and the one question you need to ask yourself before you put a single dollar into either. Let's get into it. Let's start with returns, because that's what everyone cares about first. The S&P 500 has historically returned around 10% per year on average, before inflation. After inflation, you are looking at roughly 7%. The number goes back nearly a century of data. It's real, it's documented, it's hard to argue with. Now, real estate. Here's where it gets interesting. The nominal appreciation of home prices in the US, just the price going up, has historically averaged around 4 to 5% per year before inflation. After inflation, closer to 1 or 2% annually. That sounds terrible, but wait, we are not done. Real estate has a secret weapon: leverage. When you buy a $400,000 property with $80,000 down, you are earning returns on the full $400,000 while only putting in $80,000. If that home appreciates 5%, that's a $20,000 gain on an $80,000 investment. That's a 25% cash-on-cash return, not 5%. That's the leverage effect, and it's why so many real estate investors swear by it. But, and this is critical, leverage cuts both ways. If that property drops in value, your losses are magnified too. Index funds give you no leverage by default. What you put in earns the market rate. Simple, clean, and no debt required. Bottom line on returns. Index funds win on raw inflation-adjusted appreciation. Real estate can outperform through leverage, but leverage adds risk, complexity, and stress. Here's where most YouTube videos fall short. They show you the upside without showing you what it actually costs to get there. Let's talk real estate costs first. Property taxes, typically 1 to 2% of the home's value per year. Maintenance, budget another 1 to 2% annually for repairs. Insurance, mortgage interest, property management if you are renting it out, usually 8 to 12% of rental income. And if you sell, agent commissions and closing costs can eat another 6 to 10%. Suddenly, that 25% leverage return starts looking a lot thinner. Robert Shiller, the Yale economist who won the Nobel Prize for studying asset prices, showed that once you factor in all costs, residential real estate barely keeps up with inflation over the long run. Now, index funds. The costs here are almost embarrassingly simple. A broad market index fund can have an expense ratio as low as 0.03% per year. That's 3% on every $100. No maintenance calls, no tenants, no roof to replace. You pay tax when you sell. And if in a tax advantage account like an ISA in the UK, sometimes not even then. And there's one more cost nobody likes to talk about: time. Managing a rental property is a second job. Researching markets, screening tenants, handling repairs, it's real work. Index fund investing can take 20 minutes a year. That is not hyperbole. For a lot of people, their time has enormous financial value. Real estate consumes a lot of it. Bottom line on costs. Index funds win decisively on cost efficiency and time. Real estate's true net returns are often much lower than the headline numbers suggests. The third dimension is one that rarely shows up in spreadsheets, but it determines whether people actually stick with their strategy or bail at the worst possible moment. Index funds are liquid. If you need money, you can sell it in seconds. That's a superpower and also a curse. Because when markets drop 30%, you can panic sell in seconds too. Behavioral finance research is clear. Most retail investors underperform the index because they buy high and sell low. The index doesn't hurt you, you hurt you. Real estate is illiquid. You cannot panic sell a house at 2 in the morning, and that illiquidity is genuinely protective for a lot of people. It forces you to stay invested through market cycles. The friction that seems like a disadvantage is actually keeping you from making bad decisions. Then there's concentration risk. When you buy one property, your entire real estate position is in one city, one neighborhood, and one building. Index funds let you own a slice of thousands of companies across every industry and country. Diversification is baked in, but real estate gives you something index funds never can: control. You can renovate, you can add a unit, you can negotiate the purchase price, you can force appreciation in ways that are impossible when you own a fraction of a percent of Apple. For people who are entrepreneurial or who just love the craft of real estate, that control is genuinely valuable. And one more thing, rental income, a property generating cash flow every month, creates a fundamentally different psychological relationship with wealth than watching a number go up on a brokerage screen. For some people, especially those like me building toward early financial freedom, that tangible monthly cash is worth its weight in gold. I used to worry that home ownership would pin me down and limit my love for travel, but I couldn't have been more wrong. Owning a home actually offers more freedom. With a little planning, I can rent it out, sell it, or move back in whenever I choose. It's an asset that supports my lifestyle rather than restricting it. Bottom line on risk and personality. Index funds win on diversification and liquidity. Real estate wins on behavioral protection and active control. Neither is objectively better. They suit different personalities and life situations. So, which one wins? The honest answer: it depends, but not in the wishy-washy way people usually mean. If you are starting out, have limited capital, limited time, and want maximum simplicity, index funds are almost certainly the better starting point. The evidence is overwhelming. The costs are minimal, the historical returns are excellent. If you have specific expertise in a local market, the time and temperament to manage your properties, and you can access good leverage at a reasonable rate, real estate can absolutely build significant wealth. In fact, many of the wealthiest individuals in history built their fortunes through property. The smartest move, most serious investors eventually use both: a diversified portfolio that includes low-cost index funds and real estate, either direct property or REITs for the real estate exposure without the landlord headache. Capture the benefits of both worlds. I leverage both assets in my own portfolio too. So, to the question who funds my lifestyle and travels, the answer is a mix of both assets. About 60% of my income flows from my home equity, and 40% comes from the stock market. To break down the performance, my property yields over 7% per year, while my index funds see an annualized return of around 15% before inflation. So if the stock market delivers higher returns, why don't I put all the eggs on the same basket? You may ask. Well, isn't that simple? Home equity and the stock market aren't the same thing. One is a ticker symbol, the other is where you sleep. Isn't an apples to apples comparison. While the market might offer higher paper returns, your home's value is tied to your location, job, and personal needs. Don't just look at the data, look at your life. You can't live inside a brokerage account, but you can live in an appreciating asset that secures your future and covers your basic needs. The one question to ask yourself: do I want to build wealth through ownership and management, or through patience and simplicity? That question matters more than any spreadsheet. Quick note: everything in this video is purely educational. I'm not a financial advisor. Always do your own research and speak with a qualified professional before making investment decisions. If this video gave you something to think about, subscribe. I break down these kind of questions that the finance world loves to overcomplicate. Next week, we are diving into my personal money golden rules. Some of them might surprise you. Drop a comment below. Are you team real estate, team index funds, or are you running both like me? Here's the thing nobody says out loud. The goal for me was never really about index funds or real estate. It was never about the vehicle. The goal is every morning at 8 a.m. instead of commuting, I'm wherever I want to be. I'm choosing how I spend my hours because my money is working. Whether that freedom came from a portfolio quietly compounding while I lived my life, or from a building that paid me rent while I slept, it doesn't matter. Both paths, done right, lead to the same place: freedom. The question is just which path you will actually walk. See you next week.